There has been a growing number of people expecting a rate hike from the Bank of Canada on the next meeting on June 7th. But let's talk about why that's probably unlikely, how a rate hike is still definitely in the cards, but why the rates are probably going to come down sooner than the Bank of Canada is currently forecasting. The Bank of Canada finds themselves in a really difficult situation right now, because on the one hand, they need to make sure that they're keeping inflation in check. Because not only is inflation wearing away at the purchasing power of everyday Canadians, but if they fail to bring core inflation down within the acceptable range, the economy may lose confidence in them. And that is a place that we don't want to go. And on the other hand, you have recessionary pressures that have been building up in Canada. And unfortunately, the rate hike necessary to battle the inflationary pressures would also simultaneously exacerbate and aggravate the recessionary pressures. And that's why I don't think that the Bank of Canada is going to raise rates on June 7th, because from my standpoint, they have more to lose than they have to gain. The latest inflation report did show a small tick upward, and the problem wasn't how much it went up, it's that it went up at all. The Bank of Canada was hoping that there would be a continued decrease in the inflation numbers, and the fact that it stayed stable, or in this case saw a small tick upward, indicated to them that maybe more rate hikes were needed. After all, the worst thing that you can do when battling inflation is to give 90% of a solution but never actually cross the finish line. So make no mistake, if these inflationary numbers don't improve and they continue to go up, even if it's a few ticks, you're going to see the Bank of Canada step in with another rate hike. Recessionary pressures be damned. The Bank of Canada, though, also doesn't want to seem like they're overreacting. They want a soft landing if they can get one. So by the time June 7th rolls around, the only information that's going to be available to them is any quarterly report that they've had from the first quarter of the year, and any monthly report that they would have gotten coming out of the month of May. What's way more likely is that they'll skip on June 7th and they'll wait for the second quarterly report to come out at the end of June. And then on their next meeting, July 12th, that would be the meeting to watch for in the event that a rate hike would occur. But it'll all be dependent on what those inflation numbers do. Now you might be thinking, Conrad, what the hell? I thought we were supposed to be having a rate decrease in 2023, not a rate increase. Well, here's what's interesting about that. In the last few months, we saw a lot of activity, both in social media and the media, as well as in the market itself, with a lot of people anticipating some kind of recession in 2023. And a lot of those people started to price it in, not only in their purchases, but in their behavior. And therein lies the problem for the Bank of Canada. The Bank of Canada is trying to clearly and loudly communicate to the markets, almost as loud as my shirt, that they are not done yet. That if the market activity doesn't calm down, they are going to have to step in again with some corrective measures. They're effectively playing chicken with the market. So when Canada essentially collectively got together and decided that the worst of the rate hikes were over, that it was time to go back to normal, that's when the Bank of Canada felt the need to step in and declare that more rate hikes, more corrective action may be necessary, and that it might be a good idea to slow the purchases. And here's where that balancing act of keeping economic activity up, but not too up to cause inflation, may ultimately balance itself for the Bank of Canada. Reports have recently come out showing that Canada's personal indebtedness now surpasses Canada's total GDP, Canada's gross domestic product. That is obviously a bad thing. But what it means is that most of Canada's economic activity, or at least a large part of it, was all fueled by credit. And that credit is starting to get tapped. Non-mortgage debt held in personal names is on the rise. In fact, it's the largest it's ever been in all of Canadian history. And we're starting to see some significant and notable rises in non-mortgage debt delinquencies. People are starting to miss payments. Unsurprisingly, when people start missing payments on non-mortgage debt, it does have a trickle effect, and you start seeing delinquencies rising or defaults rising on the mortgage side of things. As of right now, mortgage lenders are reporting that net 30 delinquencies have risen back up to pre-pandemic normalcy, but that net 90 delinquencies are still lower than what they were prior to the pandemic. So what that means, at least for now, is that those struggling to make the payments are able to work with their mortgage lender to come up with some kind of solution. But another rate increase or more time as some of these fixed rate mortgages start to convert into the higher rates, and you may see more delinquencies or at least upward pressure on that delinquency rate, which may mean that the Bank of Canada may not have to step in as people start to cap out on their credit and reduce their economic activity. So is it possible that the Bank of Canada might raise rates on June 7th? Of course, it's possible, but I would venture to say that it's more unlikely. Now, July 12th is a whole different ballpark depending on what happens with those inflation numbers. And as for the Bank of Canada suggesting that the rate decrease isn't going to happen until sometime in 2024, of course, that is also possible, but my thoughts are that that's probably meant to incite people to think that these rates are going to stick around for a lot longer than people were originally anticipating, so that they slow their economic activity. My thoughts, though, are that it's more likely that these recessionary pressures are going to continue to compound and build, and that some kind of rate adjustment downward would be necessary by the third or fourth quarter of 2023. But I guess we'll see.